The end of the personal tax year is fast approaching on the 5th of April 2025, which means you only have a handful of days left to take action to protect your money and maximise your tax allowances before everything resets for the next personal tax year. In this video, I cover 6 key things to do by the 5th of April so you don't lose out on your tax allowances, and for some people this could help save you thousands of pounds. If you're new to this channel, I'm Matt. I've been a finance consultant for over 10 years, and on this channel I talk all things personal finance. So let's get straight into the video and start with the first topic, which is ISAs. Currently, every tax year, each adult in the UK is able to put up to £20,000 per year into ISAs, and your money can then grow tax-free in those accounts. There are different types of ISA accounts that you can take advantage of, which include a stocks and shares ISA, which is where you can invest in funds, bonds and shares, and any dividend income or capital gains that you get from disposing of shares which have increased in value is protected from tax in the ISA account. Utilising a cash ISA is another option, which is similar to a standard savings account. You can get easy access cash ISAs, which is where you can access your money whenever you want, or you can get fixed rate cash ISAs, which is where your money is locked away for a set period of time and it usually pays a higher interest rate on your savings. The interest you earn on your savings can grow tax-free in a cash ISA. There is some speculation at the moment that the UK government could slash the amount that you can put each year into a cash ISA to £4,000. So if, with the current stock market volatility that we're seeing, you're thinking about putting savings into a cash ISA, it could be worth thinking about how you can maximise your savings in this personal tax year. Another option is a lifetime ISA. These accounts are used for saving towards a first home or retirement. You can only put up to £4,000 per year into these accounts, so they're slightly different to the current cash ISA and stocks and shares ISA. The benefit of this account is that the UK government adds a 25% bonus, so if you can save £4,000 in a year, you would get £1,000 free from the government. I've got another video on my channel which covers the pros and cons of lifetime ISAs, which I'll leave a link to down below. You can pay into all the different types of ISA accounts, but the key thing is you can't exceed the £20,000 per year threshold. What is really important here is that your allowance resets every personal tax year, so it's use it or lose it. After the 5th of April, you can't get back your allowance from a previous tax year as it doesn't roll over. For most people, I fully understand that £20,000 is a lot of money and I don't want to sound out of touch, but even if you're nowhere near the threshold, it's worth considering if you have any cash in a general savings account, moving it to a cash ISA, or if you have any investments in a general investment account, moving it to a stocks and shares ISA, so you can protect any future gains that you make against tax. The next tax allowance to cover is on capital gains. Each personal tax year you get a £3,000 capital gains tax-free allowance for disposing of investments and assets, for example crypto assets or stocks and shares outside an ISA. Last year the capital gains tax rates were increased. For the basic rate taxpayer it increased from 10% to 18%, and for the higher rate and additional rate taxpayer it increased from 20% to 24%. So you'd have to pay this tax for any gains above £3,000. If you're thinking about selling assets in the short term, it's worth considering whether it makes sense to dispose of some of your assets prior to the 5th of April to use your £3,000 capital gains tax allowance in this personal tax year, and then disposing of additional assets after the 6th of April to use your £3,000 tax allowance in the next personal tax year. For example, if you wanted to sell some cryptocurrency which had increased in value and the total gain was £6,000, if you sold and realised all of that gain prior to the 5th of April, you would have to pay £540 if you're a basic tax rate payer and £720 if you're a higher rate taxpayer. Whereas if you sold and realised a gain of £3,000 prior to the 5th of April and a further £3,000 after the 6th of April, then no capital gains tax would be due, as it would be within your tax allowances for each personal tax year. Another thing to consider is utilising the spouse allowance. If you live with a spouse or civil partner, you can transfer assets to them on a no-win, no-gain basis. For example, you could transfer crypto assets to them that give rise to a £3,000 gain, and when they receive the crypto assets tax-free, they could sell it and use all of their capital gains tax-free allowance. And you could do the same, so that combined you have £6,000 of gains sheltered from tax each tax year. The key thing is to make sure that you transfer the assets before you sell it and realise any gains. The third tax allowance to consider is for dividend income and savings interest outside an ISA. Each tax year you get a savings allowance, meaning that you can earn up to £1,000 of interest tax-free if you're a basic rate taxpayer, £500 of interest tax-free if you're a higher rate taxpayer, and £0 if you're in the additional rate tax band. It may seem like a lot of interest to be earning, but it can catch you out, particularly as interest rates on savings have been a bit higher over the last couple of years. If, for example, you had £20,000 in savings at a 5% interest, then you would earn £1,000, and if you're a higher rate taxpayer, then you'd be liable to pay tax on £500. So that would be quite a bit of money lost to tax. So again, it's worth thinking about putting your money in ISAs in this situation. Separate from this, you also get a dividend income tax-free allowance of £500 per year. The tax on dividend income above this outside an ISA or pension is 8.75% for basic tax rate payers, 33.75% for higher rate taxpayers, and 39.35% for the additional rate taxpayers. So if you're earning over £500 per year in dividend income, consider moving these investments into an ISA to protect any future income you get from tax. The fourth tax allowance is for pension contributions. The tax considerations for pensions can be complex, but I'll cover some of the basic points to understand. Each tax year you're allowed to contribute into a pension up to £60,000 or up to 100% of your income, whichever is the lower amount. This threshold includes a basic rate of tax relief, meaning that between you and your employer, you can contribute up to £48,000 with tax relief up to £12,000 being added on top by HMRC. Now I know for most people it won't be possible to get anywhere near this amount, and do note that for very high earners they get a lower annual allowance, which you can see on the HMRC website. Another pension related tax allowance to consider is paying into your partner's pension if they're a non-earner. For example, if they're off work, caring for children or elderly family members. You can pay up to £2,880 per year into your partner's pension, and then they receive 20% tax relief, so £720, topping up the total amount to £3,600. One thing to note if you're a higher rate taxpayer is that it may be more efficient to pay into your own pension because you get the higher rate tax relief. The fifth tax allowance to consider is if you have children. You can contribute up to £9,000 per year into an ISA for your child between the ages of 0 and 18 years old. There are junior stocks and shares ISAs or junior cash ISAs, and this contribution is separate from your own personal £20,000 per year ISA tax allowance. How it works is that parents open and manage an account, and your child gets access to the account and is able to withdraw funds from when they turn 18 years old. Even contributing small amounts regularly can grow into significant savings over time, as your investments benefit from the power of compound interest. It can build into a brilliant financial safety net, whether it's used for education, towards a first home, or even to pay for a future wedding. Another child-related tax allowance is for junior SIPPs. Each tax year you can pay up to £3,600 into a junior pension. This includes any tax relief from the government, so that means that you could pay up to £2,880 per year, and the government would add up to £720 on top. Anyone can pay into a child's pension, so for example a grandparent might decide that they want to save for their grandchild's future. The sixth and final topic is national insurance. You currently have the chance to plug gaps in your NI record going back to 2006, but after this tax year you'll only be able to go back by 6 years. This could make a real difference to the amount that you receive from your state pension in retirement. The full new state pension is £221.20 per week. However, how much you receive depends on how many qualifying full national insurance years you have. 10 qualifying years are required to be eligible for the new state pension, and typically 35 qualifying years are needed for the full amount. For people between 10 and 35 qualifying years, they'll receive an apportioned amount based on their contribution history. So making top-ups now to fill the gaps before the deadline could be the equivalent to thousands in extra income over your retirement. If you want to do this, you can view your NI record on the gov.uk website. So that wraps up 6 key things to do by the 5th of April to protect your money and maximise your tax allowances before everything resets for the next personal tax year. This video is for educational purposes and is not tax advice. If you found the video helpful, please do subscribe to my channel, give the video a like, and I'll see you on the next video.